Yeah.
Hey everyone, my name's Andy. I'm from the Finding Value Finance channel. I've got Wen Moon or Scott over here with Sow and Reap Capital. We're going to talk a little bit about different things today. I know we talk a lot about uranium and all these other things, which is great, but let's talk a little bit about the volatility of commodities, hanging on, kind of the psychological aspects of things. I know a lot of people, we get ultra bullish because we see patterns that are forming. I get bullish when things are down. I see patterns. I see certain strength or candlestick formations. We break certain resistance levels. It doesn't mean that it has to break, a all-time high or a 52-week high. That's not when I get excited. I get excited when we're cheap and we're about to break out of a pattern. That's where I get excited. And everyone else may look at it and say, well, it's 50% off its all-time high. It's still 30% down. It's like, well, yeah, but maybe you don't know when. Maybe people don't understand that when you break certain resistance levels, like that's like winning the war. It's not the all-time high when you've got this like little wick at the top or something. Winning the war is like beating the resistance. It's like getting out in front and like breaking through all of the tackles, so to speak. It's kind of like you're at the 40-yard line, but you started at the 20-yard line. You've like blew past everyone, and everyone's like, he's on the 40-yard line. He didn't score a touchdown yet. And he's like running with no one around him. And we're like screaming like, yeah, we got it. So, I mean, yeah, maybe it's a little premature in some instances. I think that one guy was showboating, like going real slow, putting the ball behind. The one guy came and knocked the ball out of his hand against Dallas Cowboys. Hey, and if you guys know the name of that Dallas Cowboy, put it in the description link below where that happened. So, Scott, here's the question. Are commodities easy to hold? Yes, no, and why?
For me, it is.
It is? Why is that?
For me, it is. I think so. Because I've experienced it. I think that's the main thing. I think once you've experienced it, because I've experienced it in the 2000s. So I've experienced the initial commodities boom in 2000. So I was mainly in like base metals, zinc, and some gold and precious metal stocks as well from 2004 to 2008 before the financial crisis. And then I was back in silver from 2009 to 2011 and beyond as well. So I've seen it happen before. I've experienced it. I've ridden through it. And, I as I said before, one of the biggest mistakes that I've made was I was trading in and out of of a commodity super cycle. Well, it was a mini cycle back in 2000, but I was trading in and out, and I was out of the trade when it was doing crazy things. So that was one of the biggest mistakes. In 2009 and 2011, I saw the beauty of holding onto it. Perhaps held it for too long on a lot of them, but saw the beauty of holding onto it. So I know the benefit holding onto these stocks bring, and I know the benefits of sitting tight. So for me, it's easy. Like this bull market has been incredibly easy. Like no stress. I'm just relaxed. I'm just riding through it, and I know inevitably it's got to happen. So it's easy for me, but I understand that if you are someone new to trading or someone new to investments, it might not be that easy for you, because every time there's a down there, like people seem to panic. So yeah, maybe it's not easy for everyone, but it's easy for me.
So we've got the psychology of kind of holding on to all these things. You said it was pretty easy for you to hold on. And for me, it's I don't know. I just kind of, I guess I keep my eyes somewhere else. I'm not a short-term like trader thinker. I guess I'm more of a big picture view, and I want to like hold on for at least a while and get the majority of the big move. But I know we focus on like leading indicators, we do all that stuff, but here's a curveball. What if a recession comes? Like what are you going to do if a recession comes?
Well, I think, we know that there might be like a stagflation, right? And we know the environment that we're probably likely to go through. And that's why we picked out energy sector. And specifically, I love uranium because I think it's very insensitive to economic changes, because the supply demand picture for uranium is just so strong that I think it can just buck off any recessionary fears. And that's kind of exactly what happened in 2000s. I've touched on it before, but I'll just share with you my chart again. because I think this is really important. Uranium can actually move quite separately to the general markets. Okay, so this is NASDAQ on the top, and what I'm trying to do is put Chemical Corporation down the bottom, and let's just zoom into the exact period when NASDAQ did this. Okay, so basically NASDAQ back in 2000, let's just do a price range from here down to here. So this is the period. So from 2000, so this is March 2000 to April 2001. And this is CCJ. So did it buck off the trend between 2000 and 2001? Because while NASDAQ dropped 68%. That's a huge decline from NASDAQ, right? CCJ, Chemical Corporation, which is one of the biggest uranium mining stocks, did 176.3%. It's 176%. So you can buck off the trend. I mean, this is a unique story in that I think with energy, as we've talked about multiple times, Andy, you need energy. You need energy for survival. Energy drives everything. Without energy, you can't heat your home. We can't be on computer watching YouTube. I can't mow my lawn. I can't do anything without energy. So I think, production of electricity, I mean, just because you get fired, it doesn't mean you don't need any electricity. You will still be staying home. You'll still be, putting on, you will still be heating your home. You'll still need to be turning on your lights. So I think you need uranium regardless of whether there's a recession or not. So no, I don't think it will derail it.
Do you think there's anything that is unique about this market that we've gone through the past couple of years? So I'm going to name some things that are completely unique to it, and we can maybe talk about it like back and forth or whatever. So here's something that's very unique. We had a large injection of stimulus into the system in 2020. And the M2 money supply has grown by 40 or 50%, somewhere in that range, like very quickly. And people are wondering, they're like, home prices are in a bubble. They've gone up 40% in 2 years. I'm like, well, so did the money supply. So did everything else. Like, I don't see why it is that hard. And I understand that incomes didn't go up that much. But could that 40% coming into the system impact interest rates differently than previous cycles? Is there a possibility where the M2 money supply goes into a very large, boom, let's say, and then let's say it levels back off to some lower level, and we've never seen that type of movement before in the markets? It's always been driven by the real estate market. So is it possible that we go into a highly inflationary environment, we come back up very quickly, we go all the way up like we have, and then we come back down, but it's back down to a higher level, which basically, or maybe it overcorrects a little bit to the downside and then comes back up and starts to level out? Could we see something on the lines of that, do you think?
My guess is that we're going to see high inflation for some periods. And the reason why I say that is when we're talking about money supply and we're talking about M2 money supply, and a large component of that is obviously your checkable deposits in your household checkable deposits account. They are very readily available form of cash. So it's not like, your mortgage loans, for example, where you're taking out a loan and like it's kind of like stuck in your house and you can't go out and spend it. This household checkable deposits, in my opinion, is very readily available cash that you can just spend really easily on your essential goods and services, which is why I think it's going to drive the prices, the prices of everyday goods, your essential goods and services. So I think my best guesstimate would be that inflation rate measured by CPI will stay higher for longer than people expect, just because of the amount of very readily available liquidity available in the system.
Yeah, another thing that I think people kind of forget or tend to forget is inflation, by the way they measure it, is through consumer price index. And if you've got an energy shortage, then everything gets transferred to the CPI, just like we've seen in Germany and Europe and all these other countries. So what they did is they created a bunch of money back in 2008, 2009, back in that time frame, and it all went into financial investment stuff. The money is out there, but what happens when it all rotates to a way that they don't want it to rotate? Can they stop this move, do you think? Can they stop the rotation of money from moving from financial assets like the Nasdaq and bonds into commodities and precious metals and other inflation hedges? Can they stop the rotation at all, do you think?
I think it's going to be very difficult to stop that rotation, right? Because obviously, unless the Fed steps in and strongly says that we're going to be supporting the bond market, the bond holders will continue to dump their bonds, because there's just no reason for anyone else to hold the bonds right now, like US Treasury bonds, for example, where Fed has been the biggest buyer of US Treasury bonds by far. I think Fed owns like something like $4 to $5 trillion in bonds, US Treasury bonds, whereas like your next biggest holder, like China and Japan, they own like about $1 trillion. So you're talking about Fed, who owns like the biggest portion of the bond market. Telling the rest of the buyers that we're not going to be supportive of the bond market anymore. What's going to happen is that they're just going to they're just going to dump bonds. Like all the buyers are going to dump bonds unless Fed changes tone and completely flips the other way around and goes, we're going to be supporting the bond market. So I think the money flow out of the bond market will continue. I think we'll see continuation of money flowing out of the bond market. If the general equities like the tech sector isn't performing well, as you know, like institutions, they also kind of chase momentum. They chase what's working. So if it doesn't work and if it just stays stagnant for a period, they're going to start dumping. They're going to look for other opportunities to make money. And what's working right now is energy. So what's been working over the last 12 months is energy. And like in particular, nuclear is like really starting to pick up with all the billionaires talking about it too. So I think money will eventually have to flow into the commodity sector. And I don't think there's anything that's going to stop it, other than if, I don't know, actually, even if the Fed flipped, right, there's just so much liquidity available in the system. So even if the bond markets wasn't attracting new bond buyers, like there's just so much liquidity available in the system. And yeah, I don't think anything would stop it, to be honest.
So here's a question then. If they try to hold interest rates down, it's highly inflationary, because what they do is they do QE, they buy bonds, and people are exchanging bonds for cash. So now they have cash to do whatever with, and all the bondholders become the Federal Reserve or whoever's buying it, government. Well, it's not even really a government entity, but the Federal Reserve will hold it. Now, how are they going to control this? Or what are some ways that you think they're going to control it? And the reason I'm leading to is, how is oil, or how is gold, silver, and these other metals, why are they doing so poorly? Like you'd think that, we've got inflation, we've got increasing interest rates. Why the heck is gold and silver going lower though? Like why are we seeing this? What's your opinion on that?
I think it's fund flow. I think it's really fund flow. So I think obviously there will be a time when the fund flows into the market. So obviously right now, your short sellers of gold and silver. I mean, I do believe there's a bit of manipulation in the gold markets, because it's been proven many times through various court cases that, various banks manipulate gold and silver markets, right? So that's no conspiracy theory. It happens for real life. But until and unless the buyers and the money flow into these markets overwhelm the short sellers of the bank, and basically the commercial banks, I think it could stay down for longer than most expect. So and I think eventually that will flip around in a big way. So it could be anything, right? It could be China like just dumping buy orders on COMEX or something and asking for delivery of physical precious metals, and that could blow up the markets. Who knows, right? I think there will eventually come a time when that happens, but I think that money, if you're relying on the public to kind of go into the gold and silver market in a big way, I think we need to start the momentum upwards. And because that will attract, once again, the retail investors, the institutions, and so on. And I think that will be the starting point. But right now, it's kind of like doing nothing. It's been doing nothing for the last 2 years or something like that. So everyone's tired of it. There's no big money flow into these markets. So until and unless the foreign government, so the sovereign fund steps into buying precious metals, for example, on the futures markets, and also the retail starts piling in, then yeah, it can stay dead for a while, right? And that's what gold and silver markets have traditionally shown, is that their consolidation periods, unlike uranium, unlike oil, they can go on for a lot longer than people expect. I think they can go over, I mean, if you look at, I think the 2000s run or the 1970s run, they can go on for like over 1,000 days in consolidation. So, I mean, does it make sense that gold is performing so poorly in a highly inflationary environment? No. But does history show that it's possible? Yes. And that's because I think precious metals, they tend to be very slow movers. And we always talk about the fractals in the charts, right? So, and if you look at the gold chart, it's a very slow moving beast. Unlike uranium, that just goes vertical, parabolic, within a couple of years. Gold like runs for a decade over a commodity super cycle. So if you look at the gold in the 1970s, for example, it's had that initial spike up from 1970 to 1974 or something like that. And then it had like a 2 years rest and went on again from 1976 to 1980. And you know, it was going sideways for a long time. And once again in 2000s, I think its initial run was from 2000 to 2008 or something like that, or 7. And then it had a huge drawdown and then went from again in 2009 to 2011. So it does have like big drawdowns that, you know, buck up a lot of people. And that's why with gold and precious metals, I just tend to favor the physical, just because I know it can take a very long time, and the shares can be very, you know, performing really poorly over that period when the gold and silver, you know, spot prices are really lagging behind. I think there will be a time when I do want to get a lot of exposure to gold, gold and silver mining companies. But right now, I favor physical precious metals, which, you know, can't go down too dramatically. If that makes sense.
Do you think that gold and silver basically follow the M2 money supply, or do you think they follow the CPI, Consumer Price Index, or do you think that they are the same?
They are pretty much the same. I mean, if you think about it, M2 money supply is always leading because that's the money creation. And then your inflation rate traditionally follows the M2 money supply, or the growth in M2 money supply. And then with gold and silver, if you actually look at this chart.
But tell me if this is an anomaly, though. What if you have an energy crisis and your M2 money supply goes down some, but all your money's still rotating into commodities? Wouldn't that be a divergence in history?
Sorry, can you say that again?
So we've always had in history that the M2 money supply was really driving the CPI to some extent, yes, because we had basically unlimited forms of energy. But if energy were to go short at some point, could we see a large divergence between the M2 money supply and the consumer price index, where if energy goes short, money's still rotating into energy and commodities, but basically the M2 money supply levels off some?
Oh, yes, 100%. That could very well happen. And that's what gold and silver shows. So I'll just quickly show you what I mean. So what I've got here is this is gold price. So M2 money supply is in pink. This is silver price in yellow. And so what this shows is this is a rate of growth, right? Rate of return, a rate of change year over year. And so you're starting with at the same point basically. And what traditionally happens is it lags massively behind. So M2, there could be a massive M2 money supply creation, but if you look at the 2000s, for example, it was lagging, doing nothing. So M2 money supply grew rapidly from, let's say, this period here. As you can see that there's a little like acceleration here. And then despite the acceleration, gold and silver really sold off. But then what eventually has to happen is that gold and silver catches up to the money supply. And this is the toilet paper scenario that I've always used. It's like when you've got abundance of toilet paper before, you know, the medical events, no one wanted toilet papers. And so, you know, supermarkets were selling them at a discount, like 50% discount. Like I see that a lot in Australia where you get a lot of high prices on these toilet papers because like they're in abundance, right? But then as soon as the medical event hits, it's like nothing, and then everyone starts piling into these things, and so the more people get involved in these trades, and it's same with the CPIs, right? So people go, oh, okay, there's abundance of food, there's abundance of energy, whatever, right? It's not getting too expensive, so I don't need to be stacking. But when when people feel, and it's on media that we're running out of toilet paper, we're running out of food, people want to stack it. So there was lack of demand. So you could have been, in terms of grocery shopping, I could have just bought, in a typical weekly grocery shopping, I could have just bought week supply of toilet paper or week supply of food. But when you see signs of shortages of food and toilet paper, basically at the grocery store, people go in and start stacking like 2 months worth. I've had like so many people buy up extra fridges so that they can buy more meat because we're like huge fears that we're gonna run out of meat. So they were like stacking like 2, 3, 4 months worth of meat. So and that's exactly what I think this is gonna do with gold, silver, CPI, all of those things. Because right now we're not feeling the pressure of inflation. We're not feeling the pressure of energy crisis and food crisis yet. Right, so there hasn't been that paradigm shift that you always talk about, Andy, that people feel when they shop at the grocery store, when they fill up their tank at the gas station. So there hasn't been that panic, but when there is that paradigm shift, when everyone feels the inflation, this is what's going to happen. It's going to go nothing. Okay, empty money supply is growing, so it's all good. Nothing's happening, right? Because gold is massively lagging here, and then what happens is, boom, people are in fear. They run into gold. And I think it's going to be more like the 1970s, where we might be down here somewhere in terms of gold and silver, right? So 1971, it initially outperformed. And then people were like, nah, gold and silver trade's over, right? And then people feel inflation, and gold and silver just overshoots way above empty money supply, because all of a sudden, like, everyone's feeling inflation. Everyone wants to get out of the dollar, fiat currency, and everyone wants to convert that into real money, which is gold and silver. And so this is, I think, what's coming eventually. By the end of the decade, I think this type of move in gold and silver is coming. But it's just that, as I said, the consolidation periods in gold and silver can be very long. And let me just take you to what I mean by that.
Here's a question that I have, though. It's not on this chart necessarily. It's about buying metals and stuff. When I've purchased metals over the past decade plus, and when I watch these markets, a lot of these panics where the paper price goes way down, we see shortages of the actual metals themselves. So if we're seeing shortages of the metals at the same time that the price goes down, how is that possible? I mean, isn't that like incongruent to what markets should be?
Yes.
So here's a question though. Like, even in oil right now, we have the inventories in America are declining of oil. And then we've got prices going down with it. That makes no sense at all to me. All right. So how are these disconnects possible? How is it possible? How could the price go down to $12 an ounce and I can't buy it for anywhere near $12 an ounce for silver? And you go to the store, they're like, oh, it's $22, it's $21. It's got these gigantic premiums, and they're all out. They're like limiting how much I can buy. I'm like, well, if it's $12 and we just dropped 50% in like 4 months or 2 months, shouldn't this be like plentiful everywhere? I mean, shouldn't I be able to go in there with a pickup truck and say, fill the whole thing up, because everyone's just selling their silver? Where is this disconnect? How is this disconnect possible? Because, I mean, I look at this and I look at it and I'm like, these markets have to be completely and utterly disconnected, almost broken.
Yep.
Because you can't have that. That doesn't make any logical sense. What's your take on it?
Well, oil is quite simple, right? In terms of oil, we're drawing out our strategic petroleum reserve, right? So we've started off, 750 million barrels of oil in the United States as strategic petroleum reserve, and we've drawn it down to like mid 400s now, right?
Yep.
So, and we're drawing it down at a pretty rapid rate. And I think it's because of the midterm elections. And you probably think the same as well.
Mhm.
But typically leading up to elections, you've got inflation's on top of mind for everyone right now. Gold and silver is a funny one because gold and silver are typically indicators of how bad the inflation is as well. So there is definitely that incentive for the powers, powers to push down the gold and silver prices. And we know that we've been withdrawing out the COMEX inventory levels as well. So in the same way that the Strategic Petroleum Reserve going into the commercial reserves and suppressing the price of oil is putting the downward price pressure on oil. I think same thing is happening with silver and gold in that COMEX inventory levels for gold, silver, and platinum are all going down, right? And they've been going down for I don't know how long, but they've been going down for a long time, right? And so eventually there will come a stage when they run out of Strategic Petroleum Reserve, SPR. They run out of COMEX gold, silver, and platinum, and it could be quick. I think this could be. I think a lot of the gold and silver bugs have been calling this for a long time. But I think we're getting close to it where someone just dumps a huge buy order, and it could be China, it could be whoever who wants to get rid of the US Treasuries because they don't see the value in the US Treasury holdings anymore. So what are they going to do with the proceeds? Because what is a replacement for the US Treasuries, for these sovereign funds? I think the only viable alternative for them to hold on to is gold. That's what I think. So you could have a time when these sovereign funds go. I know there's I guess it's conflict. It's the tension between China, between the West and the East are growing right now with Russia, Ukraine, with China, Taiwan, all those things. So when that pressure grows, China, who knows, right? This is just a guess, a pure guess. But something like this could happen in the gold market where China dumps US Treasuries and go, stuff it. I'm going to buy up all the gold and COMEX or whatever it might be, and then just call them all in. They might just dump a huge buyout and go, all right, I want to deliver it now, thank you. Because that's how futures market works. It's right now, everything's most of the settlements are in cash. So, at the end of the month, you just roll over to the next month and no one does anything about it, right? And no one calls for a physical gold and silver to be delivered to their door. But there could be a time, I don't know, I'm just speculating here, but there could be a time when sovereign bonds go, what am I going to do with all the proceeds from sale of US Treasuries? And they might just dump it on COMEX and go, now deliver it to me. And so that will put a huge squeeze on it. That could put a huge squeeze on gold and silver market. And individuals were able to achieve in the silver market back in the 1970s, the Hunt brothers. This is the price of silver. This is the silver chart of the 1970s, right? And that was the Hunt. Well, that's supposed to be the Hunt brothers. There are different theories as to why this happened, but this is supposed to be the Hunt brothers. But if an individual like this can affect the market so much, what could a sovereign fund do? I know they were billionaires or whatever, the Hunt brothers, but if an individual, if two brothers, right, were able to put a huge squeeze to the silver market back in the 1970s, what could the sovereign funds do when everyone will have to eventually run away from US Treasuries because they're going to be depreciating assets, basically? I think it could be huge. I think this could be what's coming, but you've just got to be patient. And I think when I talk about the fractals of the gold and silver chart, this is what I'm talking about. The consolidation can be very exhausting and very long lasting. And as I said, we could be almost here in silver, for example, right? We could be around this zone where we've had the initial leg up and you've just been consolidating. But if you see this chart, it's a long consolidation. This is 1,246 days or 41 months of downward pressure after the initial leg up. So that's why it doesn't surprise me to see a huge drawdown in silver. But eventually, what's coming for silver, I think, is something like this. But it takes time. Gold and silver, they really, you never see consolidations like this in uranium. We've never seen consolidations like this in the uranium market where it does nothing for 1,700 days, or it does nothing for another 1,700 days. So does it frustrate people? Yes, it does. But will it pay off if you're patient and just holding on to your physical metals? I think it will.
Well, how do you play a market like this? Do you just cost average in as it comes down?
Yeah,
I mean, how would you want
yeah.
to play it? Yeah,
I
because
would
that's
just be like cost averaging down like through the whole rounding bottom here. Like, I mean, with these things, like just because it's not that volatile, until it goes parabolic like this, and it's just physical. Like, I mean, I've got physical precious metals now, but I never check my account. I never check dollar value of it. Like, I mean,
Mhm.
I think it was probably like 2 years ago when I last calculated the dollar value of all my precious metals holdings. So with this, it's like it's really easy to hold, I think, with precious metals, unlike uranium stocks that can be very volatile. This is something you just hold on to, and yeah, you don't really worry about for a long time. So if I just go, let's say this was the top here. If I say it was to repeat the consolidation period of the 1970s, like we could still be consolidating further until next year, end of next year. We could still be going down until the end of next year. Like, you just don't know with precious metals. Like, it's just, as I said, it's very slow. It requires a ton of patience. But hopefully what I'm going to do is, I think it's going to be all the energy that takes off. And this has been my story since the first time I came in the show, is that I think it's going to be the energy sector that runs first, because we've got an immediate problem right now around energy. So that's the trade that I want to be focused on. Uranium specifically is the investment that I want to be focused on right now. And then I think what I've learned over the time is also that things need to seem imminent, right? It's like things need to be imminent for something to absolutely just take off. And so with uranium, like, I mean, despite all the very strong fundamentals, it hasn't really taken off yet, because I think the problem isn't imminent, but I think that imminence will come very soon because of what's happening to UF6 and SWU markets and things like that, and the contracting cycle. With silver, there's no imminency right now. Like, no one's feeling like they need to go out and get gold and silver, because like inflation rate is still kind of like, people are doubting whether this is real, whether there's going to be disinflation or deflation and so on.
Mhm.
So people are not really believing in that story, and there's no immediate need for me. I don't feel like, for example, I know inflation rate's going up, but I don't feel like I need to go out there and like stack up a whole lot of groceries right now. Do you? You don't feel that, right? It's like,
Well,
whatever,
I mean,
just leave it normal.
I'm opposite. I stack up when everybody else is not doing it. So, like, I would be a buyer of like physical metals right now, just because nobody
Oh, no,
wants
no,
them.
I'm talking about food and
And food,
groceries.
I would do it with food too, to some
Yeah.
degree. I would.
Okay. Okay.
Yeah, I would
Yeah.
have,
So,
a half month or a month of food,
yeah.
because I don't know.
Yeah.
I just
I
feel
mean,
like
yeah, I've got about a month of food, but like, it's not like
yep.
I go out and stack like, months and years worth of
Oh
food.
yeah, I don't have that.
Yeah, yeah. But I think there will come a time. I mean, we're stacking a month worth of food, but if you ask an average person right now, like, I mean, they'll probably just, shop on a, weekly basis and just rely on their weekly supplies. And so I think the flow, if you look at gold and silver, the logical flow for me is energy first. So like in the 1970s, energy ran up first because there was an energy crisis. And
Mhm.
so it hit those energy costs, hits food prices, and so people tend to then go out and shop for groceries a little bit more and start stacking a little bit more. That creates even higher inflationary pressure, because, as I said, like, there are, rather than people just buying weekly supply, now they're buying monthly supply, and that creates additional demand for those goods, which pushes up the prices even further. And so when they really feel the pressure, I think that's when they try and hedge themselves beyond food, right? Because now you can't stack any more than, like, let's say 3 to 6 months worth of food, because you might not have enough space in your home or whatever. And they might, that's the point at which I think they want to seek protection, or proper protection from inflation. And I think that's when gold and silver might take off. And so my play, if this played perfectly as I imagine right now, it's going to be energy first, and then agriculture, fertilizers next, and then it's going to be precious metals until we see a deflationary pressure. So I'm hoping to play
Mhm.
all of that. Hopefully, fingers crossed, if it all works out. But I think it's just the logical flow, like energy, food, and then precious metals for protection. And then I think we'll see a huge deflationary pressure, because the economy becomes under pressure, and politicians, you've got to remember that the politicians will do whatever the majority wants them to do. So right now, everyone's like, inflation's too big. imagine if inflation was to sustain at these levels. They want to first kill off inflation. And that's why I think deflationary pressure is coming this decade, sometime in this decade, because politicians will achieve what the majority wants. Right now, everyone's like, let's fight inflation. Inflation is the biggest problem. So yeah, they are doing things to try and fight off inflation. And that's what happened in the 1970s. That's what happened, well, kind of happened in 2000. It happened naturally in 2000s because of the high oil prices. But that's going to happen. And then when the majority comes out and shouts out, no, this is bad, like deflation is bad, like we don't want deflation, just stimulate the economy. That's the end game for precious metals, I think. When after the deflationary pressure, when everyone's shouting out deflation's bad, let's just stimulate the economy, help us governments, that's when they'll come in and just stimulate the economy like crazy. And I think that's when we might have potentially second leg up in uranium and also a massive bull run for precious metals.
So here's some questions for you. Well, first I'll make a statement, then I'll ask some questions. The statement is, if they're controlling the Strategic Petroleum Reserve, if they're trying to control oil, they're probably in the paper derivatives markets, trying to push it down and do whatever. Do you think they're doing the same thing with gold and silver? Do you think they're leasing their gold out and they're doing all these games, trying to flood the market and do all this so people don't get worried about inflation? Yeah,
I think there's definitely that component. Yes.
So here's the other question I have is, let's say they hit all those buttons. They hit the Strategic Petroleum Reserve Release button to lower inflation. They hit the gold button, the silver button, the platinum button. They're controlling nickel. They're controlling copper. They're pushing everything down that they can. They're throwing and jawboning narratives out there of recession, possible recession, possible deflation, possible this or whatever. In the news, we'll say it, like in the news. They're still raising rates because they're scared that inflation's coming. Do you think that, they hit all these buttons? What makes you think that that's necessarily going to work? Like, what makes you think that they can control this if they are trying to control it? If they are, and I don't know if they
can't.
are.
I don't think they can. I don't think they can control it because at the end of the day, it comes down to inventories, as you always say. So if we're drawing down on the Strategic Petroleum Reserve, we're gonna at one stage run out of it all, and so you can't control it, right? So let's say we're supplying what is it, 1.5 million barrels per day or something like that.
I think it's like one.
One. Okay,
that's my guess. Yep, 1 to 1.5.
So if we continue at this rate, we're gonna go down to like 0 by the end of next year or something. But we're not going to go to 0. We know that. Like, they're not going to be silly enough, I don't think, to go down to 0 because that means we're completely stuffed. I mean, the US is completely relying on, imports, right? And other countries trying to providing energy for you because I think you still import half your oil supply or something like that, consumption. So they're not going to do that. At one stage, right now, what's happening with oil is that they are releasing Strategic Petroleum Reserve. So Strategic Petroleum Reserve is going massively down, and the commercial reserves are, on a very slow upward trend. So commercial reserves are building up.
I think they're still going down. They're still drawing down.
Commercial reserves are going down too?
Yes.
Okay, I thought they were going up. Okay.
No, they're going down still.
Okay.
It's crazy.
So that's crazy then, right? Because
yes.
What are they going to do if they stop that additional supply? And we know that everything's priced at margin, as you always say as well. And we talked about the water example where, the first 100 water bottles are worth nothing until you see a huge line, people waiting for water, and then you've only got 10 bottles left. And how much are they worth then? Like exactly what's happening to Europe right now with natural gas, right? So we might see those type of moves. This is only a band-aid solution to the root cause.
Yes.
And we've got fundamentally a supply demand imbalance. Right now, what we're trying to do is just put band-aid solutions over it, creating a bigger problem in the future. So what this is going to lead to is, the only sensible thing to this would have been to let the price of oil rise so that it naturally tapers off demand to some extent, right? Because that's the only way. Like, people, because the petrol prices are more expensive, they drive less, they try and save on petrol. But when you're artificially suppressing the prices and it doesn't disrupt demand, you're only creating
what
this is like you're pressing down on the spring right now.
I know. That's what I'm saying. Like, I think this is just ridiculous. I'm like looking at this going, this this is like, I mean, are they doing this on purpose? I mean, are they like saying, hey, look, we can push this down to like 85, get everybody like hooked on this stuff, like it's some sort of drug or something. Like, hey, we got it down to $3 a barrel, and then they're just gonna sling it up to like $10 a barrel on us or something, like the biggest shock. Now,
I mean,
this also impacts the consumer price index. It impacts the inflation numbers. They are literally trying to suppress this all down. But here's the thing: when this thing releases, you're going to see inflation come back like it's like no other. Now, I mean, everyone else, what they do, a lot of investors, what they do is they stare at the numbers right in front of them. They stare at them right in front of them, and they're like, oh, it went up. Oh, it went down. Oh, we've got deflation, inflation, deflation, inflation, as these things go up and down on a daily basis. I'm looking out, like I'm stepping back and going, what the heck is this? Like, I am positioning big in some of these areas because it's like, this is stupid. And when people realize this, I'm just like scratching my head going, like, what? There's no way this can end well. We are drawing down inventories even in the face of strategic petroleum reserve. Like, well, one, we're drawing down that reserve. We're doing like Enron accounting here. We're like, take it out of this one, put it into this one, and everybody's like, look, the inventory is okay. I'm like, what are you like? This is stupid. We're drawing down inventories worldwide. We are literally just drawing everything down around the world. And you're looking around, they're like, yep, there's a lot less, as your analogy, water. There's a lot less water out here. And I'm like looking at it, and I'm like looking at all the inventories, like, where's it all going? Everyone else is like, it's fine. The prices is going down. And I'm looking at this going, like, how are the prices going down the same time that you're draining all your inventory? Like, at some point, this is going to be, here's the problem. At some point, when people realize how little inventory we have, and then they look and see how little spare capacity is out there, it's like game over. Like, the price is going to go. And I think so. I don't know. I think it's going to happen 2022, 2023, somewhere in that range, late 2022, early 2023. But I don't know. I mean, these markets, I don't know. Some of them, they just don't make sense in the short term, and that's the opportunity, obviously. But I look at the oil market; they're literally drawing down inventories, and the same time the price is falling, and that just doesn't make sense. Same thing with gold and silver. The price falls down at these bottoms. I'm over there like, oh, I'm going to buy a whole bunch for this cheap price. You get there and it's like, it's all gone. They're rationing stuff. I'm like, how is this possible? How could you be rationing at a bottom? That makes no sense. It's just stupid. Like I'm a big physical, like when I saw this, guys, I'm a huge physical metals owner. And the reason is because these markets don't make sense like that. They don't make sense. And at some point, they are going to run flat out of everything. And when that happens, people are going to panic. And when they panic, these things are going to the moon because what people are going to do is they're going to say, I know this isn't out there anymore. I want to go buy some. I want to at least procure some for myself. And then it's just gone. It's like vanished, poof. And then what you could have is a broken market, much like nickel broke. You're going to have a paper market that's just there to show things, and then you're going to have a physical market, and the premiums are going to be just ridiculous. Hey, look, there's a platinum. It should be $800 per the ounce. Oh, but it's really $60,000 an ounce. You're like, what? 60,000 versus the paper price of like 800? It's and there isn't much.
I think that will eventually end. And the reason why I say that is, like, I mean, if you had a huge sovereign fund or any big institutional funds that saw the disparity between the physical price and the paper price, what are they going to do? They're just going to go into the COMEX market and go into the futures market and go, yep, I'm just going to buy a whole bunch. I'm going to call for delivery of that right to my warehouse, right? That's exactly what's going to happen. So it's going to blow it up. So I think that disparity will end. And that's why I think maybe it's like even smarter to play the paper market game. So rather than buying the physical market, so when the physical prices are really, really high in comparison to the paper market, I think it might make sense for me to go out and buy, let's say, for example, PSLV, right? So physical spot silver trust, because they hold physical silver, but they are priced at paper market prices. So I think that disparity will end eventually, because someone will take advantage of it in a huge way and just call for delivery. And I think that's when, it just rockets higher. And we don't know when that's going to happen, right? Do we know that, China's going to do it tomorrow or in a year time? We don't know that, which is why I'm just like, I don't care what it does today or tomorrow or the next week or the next month. I'm just holding on.
Well, I think it's happening in oil now too, because there's some Saudi people. They're like, well, if you guys are trying to get this price lower, and if we have, quote, so much spare capacity that you guys are spouting, and that oil is in a surplus, even though all the inventories are drawing down, they're like, well, maybe we'll cut back production. And I'm like, oh my goodness. Could you imagine? We're like drawing down our inventories at a pretty fast pace. I don't know if it's record speed, but it's been drawing down quite rapidly. And then the Middle East cuts back production at the same time. And then all of a sudden the paper price just goes like it breaks it, because what they're doing is they're selling oil over in the Middle East for like 110, and ours is going down into the 80s. We're seeing the disparities like grow all over the place, and I'm like, what is going on here? And even like the people who followed the oil market for like 20, 30, 40 years, they're like, how is this trading so weird? Like,
Yeah.
I'm even seeing it in the candlestick patterns. Like, you break out of a pattern and then you just get this fat down day out of nowhere. You're like, what is this? And then it like round bottoms up and tries to go back up again. And it's like this huge big down day. I'm like, how is this possible?
This is the craziest thing, because this could really do a flip on the United States. So if they are, as I said, if they are suppressing the prices of precious metals right now, and right now everyone's running away from bonds, like some sovereign fund is going to come in and buy that stuff. If they are suppressing the prices of oil on the futures market, right? Because that's effectively how the oil prices are priced, basically on the futures markets. And you can call for physical delivery of the barrels of oil, right? If someone's controlling that price, a sovereign fund might go, 85 oil, really? I'll take that. And like just go dump in a buy order and then call for delivery of that as well. So it's crazy. Like, you can really, flip on you.
I think they can close those contracts without delivery and pay a premium above it in cash. And they can do that. I think that's the case.
No, I don't know. I don't think you can. Unless
they
exit, unless the short sellers exit it though. If they don't exit it before the,
I think they can close it. I think they can close the contract in a paper payout and avoid a physical delivery.
They can close it. But that means if they're shorting it, they need to buy, which will push up the prices, right? Because let's say China's holding onto a bunch of like long futures contracts, right, for oil, and they don't close out their positions, but all the short sellers now have like bunch of like oil shorts that they know that the Chinese aren't closing. They need to eventually buy back. So because they're short, to close out the positions, they need to buy, right? To close out the positions, they need to buy, which will push up the prices of oil. If that makes sense.
Yeah, but I see, here's the thing though, in the paper world, they can just dump on a bunch more paper. So like, let's say you've got 100 million. They're like, I want to buy $100 million of oil paper contracts. And they're like, well, we'll just create 1 trillion paper contracts, throw it on the market all in one shot. And now we've got this huge 900 million surplus. But the physical market, like,
yep.
It's
but
like,
I'm still going to ask you for physical delivery of the 100 million barrels if I'm China, right? So that doesn't.
I think they can pay out in cash though, of some premium or something. Like they put that in the.
You can agree. You can agree on the futures market to settle cash on a cash basis, but I think that's ultimately up to the onto the buyer of those futures contracts to make that call. You need to be in agreement to settle it in cash. So I can just go, give it to me, give me the physical. And so in the United States, if we're talking about inventory in the United States or something, that inventory has to come over to China now. So It
Yeah, I think
could.
this is the reason that Russia and all these other countries are like, we don't want to deal with these people anymore. Like, I think they know that they're doing this.
Mhm.
So
Yeah,
I think
because
Russia,
they can just use force majeure, right? Clause within the Permex terms or whatever. So force majeure basically means like if they don't have physical, they can call for some ridiculous reason to say they can't deliver it. So they might blame it on like a medical event. They might blame it on like supply chain issues or whatever it might be, and they just call it force majeure and just go, yep, we'll settle the cash. Yeah, so they can do that. Permex can call for that potentially.
isn't Russia trying to open up their own like metals exchange or something like that? I read that somewhere that they're trying to open that up or whatever, and I don't know if they're gonna get it done or whatnot. Here's another question, and I see this a lot. A lot of people ask, what's the catalyst for uranium? And then they always look for like news-driven things. Do you think news really does much of anything, or do you think it's all like funds flow and behind news?
Fund flow. I think
Funds
it's fund
flow?
flow. Yes, yes. I think it's funds flow. So well, news does contribute to it in some way because that can trigger fund flow. But ultimately, the underlying thing that's going to drive up the prices is the fund flow and the fundamentals behind uranium. So we know that there are huge fundamental stories developing on the uranium right now, and it's a pretty similar story to the other commodities that we're talking about. In that we're just drawing down on the existing inventories. Spot's eating it up. YCA, Yellowcake PLC is eating it up. Kazatomprom is potentially going to eat up a huge portion in Q4 and Q1 next year. So Kazatomprom's story is quite huge because they are right now doing an IPO. They're raising money up to $500 million US to buy up additional uranium in Q4 this year and Q1 next year. So that could be huge. That's like immediately like 10 million pounds at current price. At 10 million pounds gone again. And we're talking about a supply and demand picture that looks horrific right now. So I think all those things are just gonna add to the pressure. And we're hearing from like Sprott and the people that are connected to Sprott that it's very hard to find pounds above ground right now for them to stack up. So John Chimpalera, the Sprott CEO, Spot CEO, basically came out and said, they used to get calls from these guys that wanted to sell pounds above ground, but now they're not getting the calls. They've got to be very active, and it's very hard to find pounds above ground. So I think it's real. The inventory problem is becoming very real now. And on top of that, you've got competing, other spotlight vehicles like Kazatomprom, the physical trust, as well as like YCA potentially trying to compete against Spot as well in buying pounds above ground. So it's gonna happen soon. I think it's gotta happen soon, especially if CAP buys $500 million worth of pounds above ground.
Okay, that sounds good. So I don't really have anything else to say. Do you have anything else to share, Scott? No? You're good? Always looking.
Other than be joyful always. That's
All
what
right.
the Bible says. That's what God tells us. That just be joyful. I think we're gonna. Let me show you something. Actually before we finish off. This is pretty important. It's so important to understand that we are going to experience volatility like nothing in the uranium sector, not just because of it's a commodities market, but if you look at any markets, that's going to give you insane gains. Like if you look at the growth stocks of the past, right? So if you look at like the massive outperformers of the past, they are inevitably going to go through a massive drawdown in terms of percentage terms, because that's the only way you're going to get outsized gains, right, Andy? So this is Texas Instruments, and so if I just show you the CCJ chart right now, it looks incredibly similar. So I'm just trying to find all these Livermore bullish cylinder patterns. So what we've got here, in terms of the Livermore's bullish cylinder pattern here, right? So you see that, and you see the Texas Instruments, the Livermore's bullish cylinder, is that you're gonna have drawdowns, like even going forward, right? Even going forward, you're gonna have drawdowns that are potentially like 50% per drop. So if I just do a measured move, even once we break out, even once we broke out of this little bullish cylinder for Texas Instruments back in the 1980s or 1990s, I mean, that was a 51% drawdown, right? But you're not going to get outsized gains like this without these drawdowns. And it's just like, it's just simple as that, right? So if you want a massive outsized gain, obviously if you want a very steady blue chip type of stock that's going to return you at best like 5x over a decade or something like that, yeah, maybe you won't see like 50% drawdowns very often. Maybe you'll see 20-30% drawdowns. But if you want life-changing gains in this commodities bull market, and specifically in uranium, for example, where it's extra volatile over all other commodities, we're gonna have to expect 50% drawdowns. If you're a smaller name, 70% drawdowns, 80% drawdowns. They are all possible drawdowns. But at the end of the day, as Andy keeps saying, we need to keep our eyes on our ultimate price. No one's gonna know when these drawdowns will exactly happen. Like, it's impossible to figure that out. So we'll just need to be ready for it. We'll just need to ride it, focus on the long term.
Yeah,
That's really
I focus on the market conditions and the ratios. That's what I look at as a potential sell point. But
because I mean, if you look at the gains from here, like even if you bought it right at the top here, I always say this because like this is why you don't want to sell. Like you still would have made 10x your money. Obviously, you would have done far better if you bought it at the bottom here, or even better because CCJ I think is like here, but you know you could have done 30x, 32x. So I mean, you just need to sit tight, and I'm sure you've had like multiple weeks where it was down quite a bit as well. You know, you might be testing the upper trend again, even if we are down this week, for example, right? So if I pick up like this week, for example, like that's an 11% week down on something like this. That's eventually headed for a 30x gain. So you just need to be mindful that this is just normal, natural, you know, market movements, and we need to have our eyes on the ultimate price.
now here's another question. I know some people ask this. There's like the deflation camp, right? Can we have yields go higher? They're actively going higher and have a deflationary scare at the same time. Is that possible, do you think?
It hasn't happened.
I know.
I
I can't. So like all these guys
it hasn't
and
really
girls
happened in history.
who are afraid of deflation, I'm like, well, if you have deflation, like here's a really weird thing. We see a divergence happen between copper gold ratio and interest rates right now. They are diverging. You know when else we had that divergence? 1970s. The 1970s had that same divergence. We had copper to gold ratio go down and interest rates go up. So that's why I keep thinking we're like the 1970s. Energy crisis. The crisis is going to bring interest rates up with it because of consumer price index. Everything else is going to look like trash. And what happened in the 1970s? We had three assets kill it: real estate, precious metals, and energy, or commodities in general. Those are the three.
Yep.
Copper did not do very well in relationship to gold during that time frame. Gold vastly outperformed. I think that's the same market conditions that are coming ahead of us. That's my take. If that's my take, then I think gold, platinum, silver, they're all going to do well. And I think that energy is going to just dominate. Because I think we're the most similar market conditions to the 1970s. Do you agree? Disagree?
Yes, I agree. Yep. I agree. And in the 1970s, as the rate was rising, like it just chased inflation basically. So as the inflation rate was rising rapidly, the interest rate rose with it. So I think inflation rate, I can't pull up the figure right now, but basically inflation rate went from like something like 4% to like 17%. Interest rate also went up to like 17-18% at the same time. And latest example really is the Turkish lira. If you look at this is US dollars in comparison to Turkish lira. And obviously US dollar is strengthening massively against Turkish lira because as we know, Turkish lira has been depreciating quite a bit. But what do? They raised the interest rate to 24%. right? So this is a huge spike from 8% to 24%, while inflation, sorry, this is basically the depreciation of Turkish lira, while the Turkish lira was depreciating at pretty much the fastest rate. So does rise in interest rate fix inflation? No. Does it chase inflation? Yes. That's what I think happened. They just simply chase inflation. And it just means inflation out of control. When interest rates are going up like crazy, I think it's just an indication or a confirmation that inflation is out of control.
Yeah, so the Federal Reserve is not really driving this. They are at the whim of whatever the markets are doing.
Yeah. Yeah.
And so when people say they've got the deflationary chisel out there chiseling away, it's like, no, they don't. They don't control this.
No.
All they're doing is they're trying to control it.
They have to just.
They're trying to control it through the Strategic Petroleum Reserve releases, and it's going to end with a coil that's about to explode to the upside, a coiled up spring. That's my take.
Yeah.
And we'll see this winter what happens.
I agree.
Late this winter.
Okay, I'll just share with you what happened in the 1970s as well. So we've got, I'll just make this clear. Change to blue. So the blue line here is the inflation rate, right? So this is USI RYY, so year-on-year inflation rate in the US. And we've got the pink line here, which is a Fed funds rate. So as you can see here, the inflation rate always leads the Fed's funds rate. And all that's showing is here, if you look at this period here, inflation rate was sitting at 2.67%, and it rose to 12.3%. And as you can see, the pink line, the Fed funds rate just lags slightly behind and just chases inflation. And that's exactly what I expect this time around is, it's just going to chase it. We are rapidly trying to catch up with inflation right now. We're nowhere near it. We're way behind the curve still, I think. And it just means I think inflation is going to get way more out of control than most people expect. And for the exact reasons that we've talked about around, I mean, if it wasn't for the SPR, right? And if it wasn't for all the manipulation by the government right now, I think we would have seen a far higher inflation print last time. But I think once that ends, it's just going to accelerate even more, I think. And yeah, as I said, interest rates are just following, and it's really led by the bond markets, right? So as we see inflation rate pick up, it means the yields on the bonds become even more negative. The real return on bonds are becoming even more negative, which means the bond sellers dump the bonds until we meet the rate of inflation at least. And the Fed rate basically follows the bond rate. So 2-year bond rate is what they follow. So it all makes logical sense. And that's exactly what's going to happen this time around, I think, as well.
Well, that's perfect. I actually really don't have anything else left after this one.
Okay.
So thanks for coming on, Scott. I really appreciate it. Thanks for all that insight. And if you guys definitely check out Sow and Reap Capital, don't forget, thumb up. Put in the description link the guy of the name who was running through the he was going right into the end zone, almost made it, and the guy hit the ball out of his hand, and it was like the worst fumble ever on the Dallas Cowboys. I can't remember his name. I think he was a offensive player or defensive player, like one of the linemen was the can't remember his name. Anyway.
Or if you don't know his name, then just put Wen Moon.
Wen Moon. Yes, if you don't know his name. All right. Well, that's all I've got, guys. Thanks for viewing. If you made it to the end, congratulations. And we'll catch you next time.
See you, everyone.